Hello everyone and welcome back to the Do More With Your Money podcast here at True Potential. It's our chance to update you on events in the world of savings and investments. Normally you hear from us about future planning and targeting your goals for savings and investments. Today we'd like to take the chance to pause and reflect on Q2. Delighted to be joined by experienced members of our investments team here at True Potential, starting with Paul Durrans. Paul, welcome, a regular face for you all, particularly those who listen in to Morning Markets. Same goes for George Bell, investment manager here at True Potential. And a new face here, Sebastian Mackay. Sebastian joined us over the quarter. Sebastian and myself go back a few years. Delighted to have you, Seb. Welcome. So, as I said, we're going to review Q2, everything that happened in a particularly strong market for equities. I'm going to go straight over to Paul. Paul, could you give us an overview of equity markets in particular for the quarter and what we believe drove that?
Yeah, so we've had really strong returns over the quarter, and that's been led by the US market again. And that followed on from the first quarter. But really, it's been quite a narrow market, and it's been led by a handful of companies, but those companies really at the heart or at the forefront of a secular theme of AI, so artificial intelligence. And so the likes of companies that listeners may have heard or be familiar with is companies like likes of NVIDIA. So NVIDIA is up 37% on the quarter, and that's really had quite a large contribution to the overall index return. So the US market's up over 4%, and you can see actually here on the chart just how the US market has performed, but also some of those larger companies, the likes of NVIDIA, but also some of those well-known companies like Microsoft, Apple, all benefiting from this secular theme of AI. But outside of the US market, we've also had strong returns from equities in general. So the UK market up over 3.7%, so that's the FTSE 100. So we have had quite a bit of breadth within equity markets, but in the different regions, it's all been about technology. So even if we looked in Asia markets, companies like TSMC have really driven that market.
So if we take a step back from that, we're global investors, we don't have a home bias, but what goes on in the UK is important. Yep. If we step away from the US, it was the FTSE that actually had one of the strongest quarters through Q2. Why do we think that is, especially given there was some political risk going into the end of the quarter with the election, but the equities seem to look through that?
Yeah, I think importantly is the valuations. So the valuation of the UK market was, relative to its long-term history, very, very low. And it hasn't really participated. If we look at 2023 returns, the UK market's really lagged. So from a starting valuation, low valuations really count, but then you've had a couple of catalysts. So you've had improving economic growth data come through. If you think about the second half of last year, we had a technical recession. Coming into this year, improving or better than expected growth has been beneficial, but also just a better global economic backdrop as well.
And I guess it's worth pointing out that the UK doesn't really have that many tech names in the index, so to see the performance we had without it being influenced by tech was very encouraging. Sebastian, just on that, Paul mentioned these upside growth surprises for the UK. Now the starting point was pretty low and sentiment for the start of the year was quite negative, but the one thing we did see a change again was expectations for interest rates, particularly from the Bank of England. What's your thoughts on what we saw?
Yeah, I mean, just starting with the UK specific context, I think it's quite important that the UK, as you say, was coming from a very low base. And so the improvement economically that we've seen this year, particularly household real income growth, has been positive this year, has made quite a big difference. And I think that's helped some of the domestic names in the UK market.
And that's a bit of both. That's not just sticky wages, is it? It's also the fact that inflation went down a bit more than was expected. So one could argue, I guess, from a consumer point of view, that it's an encouraging increase in real incomes?
It's difficult because prices are still rising, but they're just rising by less than they were. So anyone looking at prices in the shops will not really feel that we're over the inflation bubble that we were in a couple of years ago. But the rate of inflation as measured by the CPI index at the Bank of England target is now back at 2%, so the Bank of England's target. So there has been a downside surprise for inflation this year. But despite that, the amount of cuts that market participants expect from the UK and other central banks this year has significantly reduced. So market participants now expect far fewer cuts than they did at the beginning of the year. And I think that's partly because people have come to understand that central banks have been very scarred by the inflation shock that we saw a couple of years ago. Just to put it into context, it was the biggest inflation shock that we've seen for 40 years. And central banks generally failed to forecast the extent of the inflation shock and how long it would go on for. So I think the result of that is that central banks in particular have been unwilling to be too bold in forecasting inflation falling. They've become very data dependent and they've become quite conservative, so quite slow to move towards rate cuts.
I suppose, and the legacy of them failing to raise rates quickly enough when inflation spiked is that they're probably now being measurably cautious on the other side, just in case we're subject to another inflation impulse.
I mean, you could accuse them of fighting the last war, but it's a kind of understandable reaction.
Yeah, it's a caution. George, I'm going to bring you in just on some of the markets and the performance we saw, but could you expand on market breadth, what we mean by that? Because Paul did introduce this idea of a very narrow market and that it was driven by tech, but we've spoken as a team about breadth and how we hoped that markets away from the US would perform well.
Yeah, I think the UK is a great example, a better economic backdrop, but also in terms of corporations and how they're performing, broader number of sectors expected to deliver positive profit growth, which is a very encouraging sign for the stock market. Also in the UK as well, a bit of interest from overseas investors in terms of bids for UK companies as well. A couple of examples through the quarter, Wincanton was one. And all of this is quite encouraging after, investors have been quite downbeat on the UK for a period of time. So we're seeing that improvement in terms of a broader number of sectors seeing expectations of stronger profits on a forward-looking basis in the UK. We're also seeing it in the US market as well. That's cooling at the margin, but generally it's not all stuck in one sector in terms of where the future of returns could lie. We're seeing it in the emerging market space as well. So the breadth which we're seeing means that, it's been exceptional for certain pockets of the market, particularly those where there's been a lot of enthusiasm behind the secular theme of artificial intelligence, but that doesn't mean it's been a disaster everywhere else.
So I guess we could say we saw a diversity in the performance from equities. So let's take it into what's important for our clients and viewers here, which is how our managers performed over the quarter. What were the encouraging aspects we saw from the managers in terms of their portfolio changes through Q2, in terms of their forward-looking views?
Yeah, so their starting point, I think, was right. In the main, managers tend to have an anchor point and they can position around that. So their starting point has been to be overweight equity, and that was the right call. But if we look at the type of equities which they're holding, US has been one of the key contributors to their portfolio allocation. It's the largest stock market out there, so that's what you tend to find. We're encouraged by the fact that they're embracing artificial intelligence as a theme, but not getting sucked into the very expensive parts of the market.
Yep.
AI is going to have benefits to a number of areas, and you can profit from that. You may have to be a little bit more patient, but you may get there with less volatility than in some of these very concentrated areas of the market. We saw them navigating the political volatility which we saw in Europe. We saw them build allocations to the UK. So as an investment house, we became more constructive on the UK. We moved from negative to actually a neutral positioning on our dashboard. And if we think about how our managers also reflected that, you had Allianz, you had UBS, You had 7IM, who were adding on a passive basis, but then on a more active basis, in terms of selecting products which implement on an actively managed approach, we saw Schroders, and we saw the internal fund Growth Aligned as well also add and identify a product which has got very strong track record.
And I guess we could make the point here that we don't need to see a big shift up in growth expectations for equity markets to do very well. Equity markets often just look at the direction of travel for growth and will very much front run that move, won't they? And this is probably where the UK benefited most, because we had such poor expectations going through Q1 in particular, that even just a modest upswing in expectations, as you said, many of the managers jumped on that and positioned appropriately.
Even in the quarter, you had two halves really. You had the first part of the quarter where inflation concerns did start to reinstate themselves, but the fact that you had such strong earnings expectations from the AI-related stocks, it almost propelled through, and they carried on despite concerns of inflation trending higher. But in the second part of the quarter, a lot of those inflationary concerns actually started to abate. And what we saw is a number of managers acting on that signal and starting to build their bond allocations.
And you don't need to see a big uptick in earnings expectations again for the equity market just to look through that and go, well, this is the direction of travel. We can bring forward some earnings expectations, and you see these moves in the indices. And the UK probably did benefit from that again.
So the managers which at portfolio level we've got the largest allocations towards, they were actually acting in a way which was very favourable for the direction we want to take our portfolios. But encouragingly, the hedges within our model. So we've got managers who may have a slightly different view, but they're there for diversification. If the facts change, we want to have managers which we can lean on. And they stuck by their discipline, and they demonstrated that they are really sticking to their guns in terms of their
that's a good point, just on diversification, how some managers are different. We'll come back to that at the end, actually, I think, George. Now, Paul, I'm jumping about a bit from the on the agenda, but before we bring Sebastian in on sovereign bonds, it might be worth just reflecting where we are or where we were in the global economy if we think about how the US was leading. And we had spoken about, as an investment team, this idea maybe of global growth optimism being led by the US. How would we say that story evolved over the quarter?
I would say the expectations for global growth outside of the US hasn't come through as strong as perhaps we initially thought. It's been varied. If you think about European growth, it's stagnated somewhat, being challenged by the political uncertainty, particularly in France. And China's been somewhat disappointing. They've recently cut interest rates this week to try and stimulate growth, but just challenged by the ongoing stresses within the property market and weak consumer sentiment, really. There are some positives, and that's coming from the UK, but also from EM outside of China, in the likes of Asia, where the manufacturing cycle is gathering some momentum. But the US economic impulse remains the strongest. Last year, economic growth was exceptionally strong, but we're starting to see some normalisation as supply and demand come into better balance as the post-COVID tailwinds start to come to an end. We're seeing employment remain healthy, but unemployment is ticking higher. So over the last 12 months, US employment's gone from 3.5% to 4.1%, but that's due to an increase in the supply of workers rather than job losses. So it's more of a normalisation from the US, which is encouraging when we want to think about inflation and the future path of interest
rates. So if we think, it might be difficult for some of our viewers to comprehend, but it's over 4 years since COVID, but we're still talking about some of the aftershocks. So the US, as you say, normalising, is probably recovering from the excesses of the stimulus they did there, whereas the UK is probably recovering on the other side, which is the lagged effects of the inflation impulse on the supply chain's goods. And so we're probably seeing a meeting somewhere in the middle where the US and UK economy will eventually possibly meet.
Exactly. It's coming into better equilibrium, and markets want that. They want not excesses either way, and markets are looking forward and just really focusing now on the earnings cycle and on the interest rate cycle.
And of course the UK had the strongest economic surprises over the quarter, didn't it? Yeah. So it shows you just how low the base was for the UK to perform well. Sebastian, let's bring you in again. We've spoken a lot about equities. Now, bonds perhaps behaved the way we would have thought, given we saw economic surprises. Could you provide some colour on the direction of bond yields and what that meant for bond returns over Q2?
Yeah, it was kind of a quarter of two halves. So the start of the quarter, we were still getting some slightly worrying inflation numbers from the US, for example, that made investors nervous that perhaps central banks' job of fighting inflation wasn't complete, and that they even started to speculate that the next move in interest rates might be higher rather than lower. But then towards the end of the quarter, we got a couple of much lower inflation readings from the US. We got some low numbers elsewhere as well. And that really helped to calm markets' expectations that really central banks have probably completed the job of fighting the inflation bubble or surge that we've seen over the last couple of years. And I think for bonds, it's really meant that the risk reward of holding bonds has improved in their favour. So previously people were worried about a sharp move higher in yields and lower in prices, whereas now we can kind of see that the end is in sight for the surge in inflation expectations that has hurt bonds.
It's fair to say that bonds haven't really behaved as we thought they would the last 2 years, given the fall in inflation. I mean, if we just think about the UK, it's fallen from over 10 to 2, and yet bonds haven't really delivered the sort of positive returns we would have hoped for. How would we help our clients and viewers understand that?
I think it's going back to just the scale of the inflation shock that we saw a couple of years ago. So, inflation peaked at 11%, for example, in the UK. That's something that we haven't seen for a long time. So I think that had a long-lasting negative impact on the bond market. The bond market in the post-global financial crisis era has just become used to inflation not being an issue, and then suddenly it was the biggest issue in the market. So I think it took a long time for investors to kind of work through that scarring and that angst that had been caused by that inflation
And the
shock.
one thing you've said before that hasn't happened yet is the interest rate cuts, which usually help fuel positive returns from bonds. We've just got central banks keeping their foot on the brake.
Yeah. I mean, looking at the performance of bonds in the second half of the quarter, which was a bit better, I think bond investors are looking forward towards interest rate cuts. So, for example, we have market expectations of cuts to 3.5% over the next couple of years in the US and the UK. So quite significant rate cut expectations now priced. And I think investors are tentatively embracing the idea that bonds can act as a good diversifier for their equity exposure again, having not been a good diversifier over the last couple of years.
And Paul, you were wanting to come in there?
No, just I think an additional factor that markets have had to contemplate with and really anchoring yields higher is just the fiscal deficits that the US, UK are running are extraordinary, really, for this part of the cycle. And you're seeing a lot of issuance come into the market that the market's having to digest, and that's just pulling yields higher than what you typically expect.
And of course it's an interesting segue, because what we did see just towards the end of the previous quarter was that issuance in the US in particular faded a little bit, and it did help bond yields come down a bit and prices go up. It's an interesting nuance which is particular to bonds. So let's stick with bonds, but we've talked about sovereigns. Paul, let's go into corporates, because of course corporates borrow in the bond markets as well. And whereas we didn't quite see the returns we would have hoped from sovereign bonds, credit performed okay over Q2.
Yeah, I think it's important to distinguish between high yield bonds and investment grade bonds. So if you think about a public company, it gets a credit rating. The lower the credit rating, you typically associate them with high yield bonds. If the higher the credit rating, they're being known as investment grade. For the lower credit rating companies, high yield bonds provide you a higher return through a higher interest rate payments, but they do come with default risk. But they've been performing, high yield bonds have been performing particularly well because the economic cycle in the US has been very robust, so the chance of default is lower, and also the yields that are on offer, something around 7.5% to 8%, are extremely attractive. These are kind of returns that you would expect from an equity market in a typical year. So that's pulling in a lot of demand, a lot of focus on this asset class, and it has been performing well in the second quarter, up 1% for global high yield. It's an asset class that we've been overweight within Growth Aligned, but also within the True Potential portfolios.
And it's a higher risk asset class, isn't it, within bonds? So you are rewarded for that risk, particularly if you, as you said, Paul, you're in a cycle where we haven't seen the defaults that you would typically expect to see at the end of an interest rate hiking cycle. So let's stick with risk markets and move on to commodities. Paul, just a comment from you really on gold. And again, it's an asset class which continues to surprise us to the upside, which I'm sure George will speak about when we talk more about some managers at the end.
I suppose some investors may perceive gold as a useful inflation hedge. That hasn't been the case over the last couple of years, and if we think about how inflation has been trending, as we've already commented on, it has been falling, albeit prices still increasing, but gold has really been pushing higher to new all-time highs, and that's really due to central banks, the likes of China, increasing their reserves and buying up a lot of gold. In the investor space, actually inflows into the likes of gold ETFs hasn't been that significant. It's really been all about central banks increasing their reserves.
And Seb, it's interesting that it's not just that inflation fell through the quarter, but market-based expectations for inflation actually remained quite low, quite benign. So it's for gold to perform well in that environment, again, is surprising, but probably does segue into Paul's comment that it's been driven by something unusual.
Yeah, I think a lot of the, as Paul has already mentioned, a lot of the demand has come from central banks diversifying their foreign exchange reserves, particularly out of the dollar into gold. And that's really the result of the actions that the US took after Russia's invasion of Ukraine against Russia to restrict access to their dollar reserves. And I think that has led to a lot of countries around the world thinking about diversifying their holdings of foreign exchange away from the dollar into gold.
Yep, and before we sort of summarise it with George in terms of how our managers have added value through advanced diversification, it might be worth just looking forward. So this isn't something we've discussed ahead of this, but the key risks, for instance, in the next 3 to 6 months, there's been a lot of politics just in the last 6 weeks. So it's, we need a big crystal ball to make forecasts. But Paul, just for yourself, just in the UK, what would we see as the key risks and opportunities, perhaps economically?
I think it's thinking about economic growth, and economic growth has been surprising to the upside, despite interest rates remaining unchanged at 5.25% base rates. It's whether we actually get that interest rate cut come through from the Bank of England. We talked about inflation being at 2%, but services inflation remains 0.5% higher than what the Bank of England are forecasting right now. So really, the risk to me would be if interest rate cuts don't come through in the next coming months, and that would be, I think, a headwind to US equity markets.
And of course, I think the one thing to note is that even if the Bank of England do cut rates, millions of mortgage holders are going to be rolling on to a much higher rate on their mortgage. So that, if in many ways that sort of interest rate tightening is already in the market for households and consumers. Sebastian, just on the US, just thinking it's probably the market with the most risk ahead, given what the news we've heard from the White House this week. But just in the immediate term, if we don't focus on the election, but what are the opportunities and risks within the US?
As Paul's already spoken about, the growth indicators are softening a little bit in the US. So particularly on the consumer spending side, we saw the surprisingly resilient consumer spending over the last couple of years, primarily due to the support from the government during the pandemic. But those excess savings that consumers had built up have now largely been worked off. So there is a bit of a worry that typically a cycle doesn't just roll over and then flatline. It typically you then tend to slow and perhaps move into something more serious. Our expectation is that it will actually be more of a normalisation of growth rather than something more significant.
And that's probably what we're hearing as well from corporates when they're giving feedback to their investors on earnings. We're hearing that it's just more the consumer is actively pushing back on price rises.
Yeah, I think that there is a bit of resistance. They're being more discriminating, I guess. I think now that they don't have those stimulus checks in their bank accounts to spend, they're being a bit more selective about what they spend their money on.
Just on to that, just thinking about someone like Ryanair reported earnings yesterday. They were talking about that the consumer's still happy to spend, but they've just been more frugal with that spending.
Yeah, I think it was perhaps easy to pass through 10% price rises when underlying CPI was 15, but now that underlying inflation might be somewhere close to 2, that's probably it for corporates to push through excessive price rises. So it could be encouraging for the cycle in the sense that the consumer, very healthy, is actually pushing back rather than saying I'm completely done.
I suppose another potential opportunity, potential scope for disappointment is investment related to technology. So I think there are quite high hopes that investment related to artificial intelligence will pick up quite significantly over the coming years. So that's obviously a potential for either upside surprise or disappointment if those expectations are disappointed.
And we're very much in a cycle of upside surprise, aren't we, with earnings beats quarter upon quarter from the tech sector in particular. George, we'll round it off with you because you gave us a good overview of where some of our managers have taken the opportunities and capitalised on that through Q2. But you mentioned this phrase, advanced diversification, which is so important for us here at True Potential in the way we select and move capital between our managers. Could you build that out and give us perhaps some examples of how that's worked over the quarter?
Absolutely. We, as you mentioned, we're selecting managers who are genuinely different from one another. They've got different ways of implementing their view, different ways of expressing their view, and their views in themselves differ. So let's have a look at an example. We've talked about inflation. We talked about it being evident in the first half of Q2. We were also discussing this in Q1 as well. So we got ahead of this. We pulled the lever on 2 of our key diversifiers. We upweighted Schroeder in our model portfolios. Now, Schroeder's a manager who is more concerned about inflation. They hold less of the stuff which would be hurt in an inflationary environment, such as fixed income, such as more expensive equity. They hold more of the stuff which would genuinely offer you the diversification, gold. They've got less in bonds. They've got more in alternatives. The valuation of their equity book is lower. So we increased our allocation to that manager, and we funded that allocation from a manager who is much more defensive in terms of their allocation. They've got a much lower allocation to equity within their portfolio. So we got ahead of that. That started to come through in Q1, and that was the right call if we look for client delivery in Q2. Schroeder were the best performing manager in that suite.
That's a key point there, George, because you mentioned got ahead of it. That was a choice that yourself, Chris Leyland and the team had made, which was you were going to move money from that manager who was more cautious towards Schroeder's, who were more diversified but would still capture some of the upside in any economic surprises. So it wasn't just we were relying on the managers to make the move, it was actually a decision yourself and the team had made.
Exactly, and we made a similar move within the cautious income portfolio as well, taking an allocation from a manager who might be a little bit more challenged if we see interest rates held at their current higher level for longer, and we allocated that money to a manager who serves us as a better inflation hedge whilst keeping the income delivery very similar as well.
And what about managers who were the most optimistic on growth? Did they perform as we would expect in terms of just their equity focus through the quarter?
Yeah, I mean, key to the returns was managers who had a bit more in the US and a bit more in terms of what we would call market cap or larger businesses within there. So if they had any of the exposure to those who were benefiting from artificial intelligence rallies, they did very well. If they had broader exposure to the market where you were seeing upside returns because earning sentiment was improving or the economic data was improving, they also did well as well. So what I would say is our core allocations, allocations to managers such as UBS, to Allianz, to Growth Aligned, they were also very beneficial to portfolio returns. But encouragingly, the active change which we made to our diversifiers, that also paid off for clients as well.
Great stuff, gentlemen. Thank you for your time today. If I was to summarise, what I think I've heard is that growth is normalising, but that's to be expected where we are in the cycle. We're at the very end of COVID headwinds, and that some of those can maybe turn to tailwinds, say for the UK, where, Sebastian, you said that we're seeing real income growth in households, and equities, of course, have performed extremely well, but as have the diversifiers, George, which you mentioned. Gold has done particularly well, and it's great we've got a manager who places so much faith in that asset class. So thank you, everyone. That's all for today. We hope that's been beneficial for you to understand the portfolio returns you had over the previous quarter. Please do like and subscribe us on our YouTube channel. By subscribing, you will get this content provided to you. That's all for today, but please join us over the rest of the week for our morning markets updates from the investment team. Take care.